My name is Sandy Price, and I'm an anti-money laundering AML Manager at ICAEW. We are an AML supervisory body. This was recorded in August 2025 and reflects the regulations and requirements at this date. This is part 2 of our series on customer due diligence and covers risk assessments and enhanced due diligence when you have higher risk clients. So what are we going to try and cover today? We're going to talk about enhanced customer due diligence and what it means and when to apply it. What might you consider as part of your customer risk assessment, the second stage of customer due diligence? What should you document? And if your AML supervisor wants to see your documentation, what might they expect to see? We've got a couple of examples of a risk assessment. And then finally, I think it's useful to know what additional measures you might take to verify a higher risk client or mitigate those higher client risk factors that you've identified. So let's talk about when a firm might need to perform enhanced due diligence. So what do the regulations say? So they say you should perform enhanced due diligence in any case where your professional body supervisor has identified a higher risk. So that might be in relation to the type of client, the service you're providing to the client, the location of the client, and so on. Your own firm-wide risk assessment may have identified a higher risk, so you might have identified a specific type of client that you think may elevate the risk or is more risky than the rest of your population. In that case, enhanced due diligence would be required. Now, the regulations also say you must perform enhanced due diligence if you have a business relationship with a person, entity established or linked to a high-risk third country. Now, at the moment, the high-risk third country is any country that's on the FATF, Financial Action Task Force, black or grey list. However, that is to change imminently, and we expect the change to be effective as early as February 2026. And at that point, it'll change to countries that are on the blacklist, or that's what we think will happen. We'll update the recording as soon as we have more information on what the geography triggers for enhanced due diligence will be. But we do expect that you'll still need to refer to information such as a grey list so that you can form a judgment about where risk lies. The regulations also require enhanced due diligence if you've got a customer or potential customer who is a politically exposed person, a PEP. Also, if they're a family member or a known close associate of a PEP. You perform enhanced due diligence if you've got a customer who you think has provided false or stolen identification documentation. Now that seems fairly obvious, doesn't it? Or a client with complex or unusually complex or unusual transactions with no apparent economic purpose. So let's reiterate the prior slide in terms of what the regulations are specific about. You must perform enhanced due diligence with clients with strong links to high-risk third countries. Now, as of today, that's all countries on the Financial Action Task Force black and grey lists. But the imminent changes to regulations, we think maybe from February 26 at the moment, say all countries on the Financial Action Task Force Call for Action list, which is a lot shorter than the current black and grey list combined. However, as we've said, you would still want to look at the grey list to see whether you feel that there are risks associated with those countries and your client, and you need to elevate the risk anyway. Again, politically exposed persons, PEPs, politically exposed person or PEP means an individual who is entrusted with prominent public functions, other than as a middle ranking or more junior official, and there is lots of guidance around there on what a PEP is. And, of course, a family member of a PEP and a close associate of PEP. So what do the regulations say you must do if you've got a client in a high-risk country? Well, you must obtain additional information on the customer and its ultimate beneficial owners, and just explore the intended nature of the business relationship more. You should obtain information on the sources of wealth and source of funds of the customer and the customer's beneficial owner. Where there's a transaction, obtain information on the reasons for the transactions or obtain the approval of senior management for establishing or continuing that business relationship, and increase the monitoring of the business relationship by increasing the number and timings of controls applied. Okay, so the hardest part might be the risk assessment. So what do you need to consider as part of my risk assessment? I've included here the sort of 5 categories that regulations say that you should consider. And I think it's quite convenient to split your risk assessment into these categories. So for the client itself, are they a PEP, politically exposed person? Is it a cash business? Are there risks that the client is understating income? Or is there a risk that they're banking cash on behalf of criminals? Have a think about that in your risk assessment. Maybe the client's dealing in crypto. You want to understand more about that. Is that a risk? Maybe they're exporting parts to countries that are close to high-risk third countries, high-risk countries. What parts are they exporting? Are there risks associated with that particular product? Then think about services. Are there any risks associated with the services that you're providing? Payrolls can be considered higher risk, company formation also, and insolvency. Are there risks associated with that service specifically? Geographical, we've talked about high-risk third countries. You have to, of course, consider whether, if your client is one of these high-risk third countries, what enhanced due diligence you might perform. But some firms, if they're very much got a client base that's local, in their town specifically, might consider any client based overseas as high risk because they would want to know why that client has approached them. If you're a rural firm, somewhere on the south coast maybe, and a London firm approaches you, you've got no London clients, you might want to think, well, why have they approached me? Why haven't they picked a local accountancy firm? Think about the risks there. Transactions is more around, will you handle client money for the client? If you are, you risk handling the proceeds of crime. So that would elevate the risk. And delivery, although it is not necessarily higher risk if you haven't met the client, have a think about whether it makes sense. We live in a very remote world now, and it is quite acceptable not to have met the client, but think about why. Have you had a Zoom meeting? Do you need to perform just a little bit of extra work to prove that they are who they say they are? So what should I document? Well, we have talked about this in part 1, so I won't concentrate too much on the identity and verification. But we will expect to see or know your client information that will inform your risk assessment. And certainly we need to confirm that you know who the ultimate beneficial owners are. What's the business trade? Who are the type of clients that they have? That sort of thing. Then documenting your risk assessment, and we talked about on the prior slide. So there should probably be a conclusion, whether it's a low risk client, a normal risk, or a high risk client, and then some justifications to why you've come to that conclusion. Now that can be free form. It doesn't have to be a checklist. And actually some of the best risk assessments we see are free form documents where the firm or the sole practitioner has thought practically about what is the risk of this client facilitating money laundering or me enabling them to do so if I take them on. It's a common sense judgment in most cases. And finally, we expect to know how you've verified the client is who they say they are, and how have you mitigated any risks that you've seen. For example, if they've got significant assets, have you done some work to investigate the source of funds and ensure that they're legitimate? So I've got an example of a risk assessment. Now this just is a free form one. Obviously there are many checklists out there and there's no harm in using a checklist. But what I wanted to emphasize, for a small firm, a free form document would be fine. And we accept those, and quite often they are more effective in terms of assessing risk than ticking lots of boxes. So here we've got a client they've described the client, is a carpenter, he's self-employed, he's not a PEP, he's not a politically exposed person. Sources of wealth, the business income only, no evidence of living beyond his means. So they've met the client, they've had a chat with them, it all seems to make sense, it all stacks up. Delivery, well, they've met Bob, so they've met the client, they've met him at his premises. He was referred to the firm by another client as he did some work within one of the client's properties. Now that sort of mitigates some risk, doesn't it? Because this guy is clearly doing what he says he's doing because another client referred him, and you've been to his premises. You know where he lives. You can validate that. So what services are we providing? Are there any risks associated with that? Well, we are preparing his accounts and self-assessment tax return. From what the firm has seen, he keeps good records, and they have all bank statements and records of transactions. That's a positive. They've sort of mentioned to him that he must declare all his income, that it's a tax offence not to. It's a criminal offence not to. And they've got him on zero, and they'll help set him up on this. And it, again, will help with the validity of the accounts and the statements. Where is he based? Well, he's locally based. He's got a local address, and the clients are local, so they haven't sort of seen any specific risk around the location. And he doesn't want the firm to handle client money. So no risk of handling the proceeds of crime necessarily. Again, lesser risk there. So that might be quite a reasonable risk assessment. You've just thought logically about the client, and you've come to a conclusion. And you might conclude on the basis of that it's normal risk. How have you verified? Well, you would write, passport provided when I visited the home address. So I've verified he is who they say he is. And in this circumstance, I'm not sure that you'd want to do anything in addition to all of that because you haven't got any high risk. And then you might sign and date the partner, or partner might sign and date it as approved for take on. So how about perhaps a higher risk example? Let's talk about that, shall we? So let's talk about what might potentially be a high risk example. So you've got the client, they are letting properties. They've approached you and they've got two beneficial owners. They confirm that. The firm's met one of the beneficial owners who is UK based. And they've got details in their file. But the other is based overseas. And I'm going to call it a high risk third country because these tend to change. And in time, if I list a specific country, it might no longer be high risk. So let's say this is a high risk third country under the current regulations at the time you're listening to this. And they haven't met this other beneficial owner. They've got 3 properties that they own in the UK and they plan to let them out. So about delivery, well, they'll be dealing with a UK-based owner and delivering services to him. So they'll be liaising with him. The other business owner lives overseas and they won't be meeting him. The UK client says it is his uncle. What are the services? Well, they're preparing statutory accounts. They've told the firm that they keep good records and they have all bank statements and records of transactions. The firm's going to also complete the corporation tax return. Owners plan to complete their own self-assessment tax returns. So it's a bit odd there. They want them to do the company accounts and the corporation tax return. They want to do their own self-assessment tax returns. And sometimes this can be a signal of a risk where the client is using different professional service providers for different services because they're trying to obfuscate what's going on. So geography, although the company is UK based, there is a beneficial owner living in a high-risk third country, and he's a high-risk third country national. So you have to perform enhanced due diligence here because you've got one of the owners living in a high-risk third country. The regulations require it. This has to be higher risk. Also, they've asked if they can use our client account to collect rents and pay some bills while they set up a UK account. So we've got a risk there, haven't we? We've got the risk of handling the proceeds of crime. And also, you can't offer your client bank account if you're an ICAEW firm as a banking facility. And why can't they, or why haven't they got a UK bank account? And what are the risks that they might not be able to get one? So what's the conclusion here? Well, it has to be high, the conclusion of risk of money laundering, because the beneficial owner, or one of the beneficial owners, is based in a high-risk third country and is a national there. Also, they want to access the client account. That's a risk, and property management is potentially high risk. So people like to buy and invest laundered money in very high value assets. And is this a corporate vehicle to launder funds? So what about verification and enhanced due diligence? So they've said the passport was provided by the one business owner when they visited at the home address, the UK one, and that's been verified. They asked about sources of wealth. Obviously, there's significant assets there. The business owner states it's family wealth, but no indication of where the family sourced its wealth, so they can't find anything on the internet or sort of understand where the money's come from. The individual in the high-risk third country has provided passport, but they can't see him. They've been told he's got no Wi-Fi, so they can't have a Zoom meeting, and that all seems a bit odd because in the world that we live in, most people can be seen remotely, can't they, using Zoom or Teams or other social media. The properties are confirmed as owned by the company, but they are very expensive properties in London, and we are unsure as to why the firm has come to us. Neither of the business owners are local to our firm, so then that's a little bit odd, isn't it? Vague as to why they want to use our client account and how much might be going through it. They mention overseas investment from the business owner in the high-risk third country. They've rightly checked sanctions lists and neither party appear on sanction lists. The electronic verification checks verify the UK business owner, but they haven't got enough information to verify the overseas individual, although he does not appear to be a politically exposed person. So the partner has referred this to the MLRO for review. Now he or she has rejected the application because they're unsure about the second business owner. They haven't got clarity on the source of funds. They haven't got clarity about why they want to use the client account. And they haven't got clarity about the purpose of business. So at this point, they've said, I'm not happy with the level of information we've got. It feels too high risk for me. I'm going to reject this client. Doesn't mean that if they went back to the client and gathered more information, that decision might change in the future. But this, it just shows or demonstrates to you that just handwriting some notes and free-form notes can provide a very robust risk assessment and a very robust verification procedure. So what extra verification checks can you make if you've decided a client may be a higher risk? Well, you can do electronic verification because that does actually often provide some additional checks that the person is who they say they are. You can perform client screening. So this is checking whether the client is a politically exposed person. Are they on any sanctions lists? Or UK sanctions lists or any other country's sanctions lists? Are they disqualified directors? And so on. So that's quite an effective way of just eradicating some of those additional risks. You can do media or open source checks. So this is a really good, cheap, effective, and quick way of checking your client. And nowadays, there's so much out there, isn't there, on the internet? You'd be likely to find something untoward. So Google the client. Do some searches on the ultimate beneficial owners and the client themselves. See if there's anything adverse out there. Who are their associates? If it's a pet, perhaps. Have a look at the company's house data. Is the ultimate beneficial owner linked to other entities? Have a look at those entities. Does anything around the company's house information or any links to ultimate beneficial owners or the entities that looks a little bit unusual or odd? Perhaps you want to check land registries for sources of wealth. Do they actually own the assets that they say they own? You might be looking at probate. I mean, if somebody says they've inherited a large amount of money, you can ask to see the probate documents. If they say it's family wealth, looking at prior sets of accounts might give you an idea, mightn't they? You can look at how many years counts, how long has this money been in that particular family's business, and so on. You might want to verify some of the non-beneficial owners who are also directors if you haven't already verified them. So in high-risk scenarios, you'd probably want to do some extra checks on the directors as well as the ultimate beneficial owners. If they've got 4 directors who are separate from the ultimate beneficial owners, maybe you'd be just doing some checks on all 4 directors just to understand who they are and their background. Simplified due diligence. Now, there are occasions where the regulations allow you to perform what's called simplified due diligence. Now, this can be applied when a client is low risk in accordance with the business's risk assessment criteria. So what has to still be done for every single client that you decide is low risk, you still have to perform a risk assessment. And that risk assessment may conclude low risk, you need to justify it, and then you might change your verification procedures as a result, or do less verification procedures. So enhanced due diligence, you have to do more. Simplified due diligence, you can do less. Your business internal procedures should be clear about what constitutes reasonable grounds for a client to qualify for simplified due diligence. And there's plenty of guidance out there. So where can you find some useful resources? Well, there's plenty on the ICAEW website. We've got a customer due diligence hub. So do refer to that for links to guidance and regulations, articles, help sheets. We've got regular bulletins that we send to our MLROs. So they'll include changes to regulations, again, links to guidance and articles, anything that we think that you need to know about. We've got a web page, regulatory and conduct news web page, which includes changes to money laundering regs, but obviously changes to regs in other areas that might impact firms. And please do follow us on our LinkedIn page. Any changes, any updates, we try and get it onto our LinkedIn page as soon as we can. So it would be great if you could follow us on that. Thank you for listening. Bye.